Welcome to the Opening Bell Report.
Hello.
Today, we're diving into an analysis report on a sudden 9% surge in GameStop stock.
And the big question, right? Is the squeeze back on for 2026?
Exactly. It's a topic with so much history.
It really is. A mix of market mechanics and some very powerful psychology. Let's see if this analysis really gets it right.
Okay, let's jump straight in. The report's opening line, I have to say, it has a great hook. It says, everyone stopped looking at GameStop, and that's exactly when it woke up.
Yeah.
And as a reader, that grabbed me. It's got that, cinematic feel.
Oh, for sure. It's dramatic. It's good storytelling.
But I see you hesitating. You don't sound convinced.
Well, good storytelling isn't always good analysis, is it?
Okay.
My issue is with that phrase, it woke up. It makes the market sound mystical.
You think it's too poetic?
It's like the stock has a personality and just decided its nap was over. If I'm a trader, reading this to make a decision, I don't need magic. I need mechanics.
But isn't that just a turn of phrase? They're making a point about the sudden volume.
But was it really out of nowhere? I mean, look at the data they include later in the report.
Okay.
They mention a stair-step pattern. That's a very specific structural thing.
Right.
So if retail traders stopped looking, like the intro says, then who was building the stairs?
That's a fair point. Yeah. If everyone walked away, you'd just see a flat line, not a structured climb.
Exactly. You can't have it both ways. You can't say nobody was watching and then, show a chart that's basically screaming institutional accumulation.
So the poetry is actually hiding the real story.
It's underselling their own technical find. That staircase pattern that hints at algorithms, maybe a gamma hedge being built up quietly.
So they buried the lead?
I think they just missed the stronger hook. The hook shouldn't be, it woke up.
It should be what?
The hook should be, while you weren't looking, they were hiding.
Ooh, okay. Yeah, that lands much harder.
Right?
It changes the whole narrative. It goes from being an accident to being intentional. The silence wasn't sleep. It was concealment?
Okay, so how do we fix that in the report itself? We don't want to lose that initial excitement. Oh, you keep the excitement, but you ground it in facts. The writer needs to pull that stair-step observation right to the front.
And the gamma hedge concept.
Yes.
Which is buried way down in the technical section. Bring it all to the top.
So a concrete example would be rewriting the opening to say something like, the market was quiet, not because the trade was dead, but because the spring was being coiled.
Perfect. And then you contrast that low volatility drift with the violent after-hours move. Use that to prove the illiquidity thesis in paragraph 1.
This didn't just happen. It was engineered.
Yes. That is a much more powerful reason to keep reading than just, surprise.
It sets a more professional tone, too. Which actually brings me to my next point.
Okay.
If the opening feels a little too much like 2021 hype, so does the villain of the piece.
Panic and cover. But the way they're described, it feels like the writer is picturing the same people from 5 years ago.
It does feel a little nostalgic, doesn't it? Like they're fighting a ghost?
The analysis says shorts are trapped because they expect the price to reject off $24, $25.
Right.
But, and we'll get to this, the report also acknowledges the company has $4 billion in cash.
The giant elephant in the room.
So if I'm a sophisticated short seller in 2026, and I know the company is sitting on a mountain of cash, am I really betting on bankruptcy?
No chance. That's the huge disconnect.
It is.
The 2021 thesis was, this company's going to zero. The 2026 reality is, this is basically a holding company with a massive treasury.
And if the shorts aren't afraid of insolvency, they won't panic in the same way.
Exactly. The whole panic narrative kind of falls apart. They might just sit and wait, or hedge. They have options.
So how does the writer save the squeeze thesis then, if the bears aren't scared?
You have to update the profile of your enemy.
Okay.
Stop treating them like cartoon villains who miss the memo. Assume they're smart. Assume they know about the cash.
So they aren't trapped by ideology.
No, they're trapped by math.
Okay, break that down for me. What's the specific angle there?
It's the classic limited upside, infinite downside argument. The report mentions DRS, the direct registration system.
Right.
Lean into that. The argument should be, the bear knows the company is solvent. They're just shorting the $25 resistance as a technical trade, a quick scalp. But because of the illiquidity, because of those DRS numbers, they can't get out the door fast enough if they're wrong.
So they're not wrong about the business.
No, they're just mathematically overexposed on their exit.
That's a much stronger argument. It shifts the conflict. It's not bull versus bear anymore.
It's liquidity versus exposure.
And that is a very 2026 way to look at it.
Right. It says, look, we know the bears aren't stupid, but they made a mistake on the market's plumbing. You analyze that $25 line, not just as psychological, but as the exact point where the cost to borrow just blows up their entire trade.
That makes the bear trap feel real again, not like a memory.
Exactly.
Okay, now, we've mentioned it twice. We have to talk about the money. The $4 billion.
We do.
This is what drove me crazy reading this. The entire case we just made about the bears relies on that cash. The report knows it's there. But I didn't find the detailed breakdown of the fundamental floor until Section 3.
It's buried. It's completely buried.
They put the most powerful argument in their entire arsenal behind a wall of chart patterns.
It's a massive structural error.
It's a pacing issue, right? You're asking the reader to believe in all this technical stuff, the gamma ramps, the stair steps.
Before you've even established the safety net. In 2021, the story was the squeeze. That was it.
Right.
In 2026, the story is the company's transformation. And if you don't lead with that, you just sound like another gambler.
It feels like they're trying to be clever, like hiding the answer in a mystery novel.
But this isn't a mystery. It's an investment thesis. You don't hide the assets. The technicals mean nothing if the company is insolvent.
The $4 billion is the so what?
It's the only reason the technicals matter at all.
So a simple reordering.
An aggressive one. You move that comparison of 2021's bankruptcy risk versus 2026's $4 billion in cash to the absolute top of the thesis section.
Before gamma, before the $25 break.
Before anything else, establish the floor first.
Because if you tell me the stock can't go below $20 because that's its literal cash value,
Then when you tell me it's breaking out at 23, I'm leaning in. I feel safe.
it validates the upside potential.
Well, risk part, it just looks like a high-risk gamble, and half your readers are going to tune out.
And the report even lists a $20 support level in the data tables. They should just use that.
Yes, use that. Frame that $2 move from the intro, not just as volatility, but as the market repricing the company's treasury.
The market finally realizing the cash is real.
That's the foundation. You have to build the house on concrete, not on the sands of hype.
Market repricing. I like that so much more than waking up. It feels actionable.
It is.
Okay, so we fixed the hook, we've modernized the villain, and we've moved the foundation to the front. But there's one last thing that just kills the vibe for me.
The ending.
The ending, we spend this whole report getting hyped. We see the floor, we see the squeeze setup, the $30 target,
And then what?
and then Section 5, risk management. And it basically says, by the way, if it hits 30, Ryan Cohen will probably issue more shares and rug pull the momentum.
Right. It's like watching a great movie and then a title card comes up that says, and by the way, everyone died 2 weeks later. It just deflates everything.
It completely undercuts the bullish tone. It feels like a legal disclaimer that accidentally became the conclusion.
It's such a conflicting message. The squeeze is back. Versus, oh, but management will kill the squeeze.
But they have to mention it. It's a real risk.
Of course.
GME raises capital into these volatile moves. It's their playbook. We can't tell the writer to just ignore it.
No, you can't ignore it, but you can reframe it. Right now, it's positioned as a rug pull, a punishment for being right.
How do you reframe dilution, though? Dilution is dilution. Your slice of the pie gets smaller.
But the whole pie gets bigger. Think about the audience for this report. They know this stuff.
They do.
So the writer needs to weave this risk into the verdict section, not as a warning, but as a strategic variable.
Strategic how?
Well, think about what we just discussed. The fundamental floor. If they sell more shares at $30 a pop, what happens to that cash pile?
It gets bigger. Maybe it goes up to $5 billion.
And what happens to that fundamental floor we said was at $20?
Ah, it moves up. Maybe the 22 or 23.
Bingo. That's the angle. You don't call it a momentum killer. You call it a balance sheet strengthener.
So instead of watch out for the offering, you say target $30, because that's likely where the company will secure funding for the next leg of growth.
Yes. Turn the risk into a trading signal. You say a rejection at 30 due to an offering isn't a failure. It sets a higher floor for the next move up.
That completely changes the psychology of it. It goes from, I need to sell before the company does, to, if the company sells, my long-term investment just got safer.
It integrates the risk into the bullish thesis. It tells the reader, even in the quote-unquote bear scenario where the price pulls back, the fundamental value of the company has actually increased.
That's an incredibly powerful argument.
And it's completely missing right now because the report is just afraid of the word dilution.
It ties everything together. The cash floor we moved to the beginning gets reinforced right at the end. It becomes a coherent loop.
It turns a disjointed list of observations into a single bulletproof narrative.
Okay. This has been a pretty heavy edit, but I think the potential for this analysis is huge.
Don't forget to like, share, and subscribe for more.